Welcome to TalkTickers, where we break down the latest earnings calls for experienced investors. Today, we're looking at a real head-scratcher, Stevanato Group. They just posted a strong quarter, beat expectations, and the stock got absolutely hammered, dropping over 8%. So what gives? Let's break down this earnings paradox.
Okay, let's dive right into this. You see this all the time, right? The numbers look solid, the company beats, and then the stock just plummets. Stevanato's Q2 earnings looked great on the surface, but the market's reaction, that told a completely different story.
It's really a tale of two tapes here. On one side, you've got a strong operational beat, revenue, earnings, the whole shebang. But on the other side, a really sharp sell-off, and on heavy volume too. So let's get into the nitty-gritty and figure out exactly why this happened.
All right, so to really understand what spooked the market, we first have to look at the headline numbers. And honestly, on the surface, they paint a very, very positive picture.
And when you look at the highlights, the outperformance is crystal clear. Revenue clocked in at 280 million euros, blowing past the consensus of 268 million. That's a solid 8% growth year over year. Adjusted EPS also came in a penny ahead of expectations. I mean, by any measure, this was a really clean beat. No two ways about it.
Okay, so let's peel back the onion a little bit. Where did this growth come from? Well, it was really driven by their core biopharmaceutical and diagnostic solutions segment, that's BDS, which was up a healthy 10%. Now, the smaller engineering segment did dip about 2%, and we'll circle back to that later. But the real story, the main event, is happening inside that BDS segment. So what's lighting the fire under BDS? It's all about their strategic shift to what they call high-value solutions, or HVS. That part of the business grew an impressive 13% and now makes up 42% of total revenue. This is absolutely the engine of the company, right? They're focusing on the higher margin stuff, like pre-filled syringes and cartridges for the booming biologics market. And this shift, well, it flows right down to the bottom line. This richer product mix pumped up their adjusted operating margin by 400 basis points. I mean, that's a full 4%. So let's recap. You've got a top-line beat, a bottom-line beat, and significant margin expansion. It's a textbook definition of a strong quarter. Okay, so if everything looked so good, why in the world did the stock sell off? What's the deal? Well, as is so often the case, the answer isn't in what they did report, but in what they said is coming next. It all comes down to the guidance. And here's your first big clue. After a beat this strong, Wall Street is pretty much conditioned to expect a guidance raise. But Stevanato, they just maintained their full-year guidance. They didn't raise it. And by doing that, management was basically sending up a flare. Hey, new challenges have popped up. And then, on the call, they laid out the culprits. First, the tariff rate on goods from the EU to the US got bumped up from 10 to 15%. Ouch. Second, they flagged a new foreign exchange headwind of about 12 to 15 million euros for the back half of the year. Third, they're now expecting a higher tax rate. And to top it all off, the outlook for that engineering segment we mentioned, it got downgraded to a low double-digit decline for the full year. So basically, that great Q2 performance is getting eaten up just to absorb all these new headwinds.
Now, to be fair, management sounded confident. They said they can manage all this stuff, through pricing actions, tweaking logistics, talking to customers. But the market clearly heard risk and uncertainty. And that big sell-off was the sound of investors pricing in all that new bad news.
All right, so let's take a step back and zoom out for a second. The market is laser-focused on these short-term macro headaches, and that's understandable. But is all that noise maybe obscuring a really powerful long-term growth story that's still firing on all cylinders? See, Stevanato's big multi-year pivot into high-value solutions, it is absolutely working. They're strategically positioning themselves right in the sweet spot of the pharma industry. We're talking biologics and self-administration therapies. This right here, this is the core of the long-term bull case. This is the whole ballgame.
And they're not just talking about it, they're putting serious money where their mouth is. They've got 200 million euros in new financing to back up critical investments. Their Latina facility in Italy is scaling up, getting ready to launch high-volume cartridge production around late 2026. And maybe even more important, their brand new plant in Fishers, Indiana, is on track to be fully productive by the end of 2028. The goal there, serve the U.S. market directly and, you guessed it, sidestep some of those future tariff risks.
And this whole strategy is anchored to the unstoppable secular trend of biologics. Get this, that category now makes up 39% of their core BDS segment revenue. Just 2 years ago, it was only 25%.
That is a massive jump. It just goes to show you this pivot isn't just some PowerPoint slide, it's a reality that is actively reshaping their entire business. So that brings us to the big question, how do you trade this? Let's break down our verdict, our rating, and a potential trade idea for Stevanato Group.
All right, for our official rating, we're calling this one a market perform. And here's why. It's really a balanced view. On one hand, the company is executing beautifully on its long-term strategy. But on the other hand, those macroeconomic headwinds that spooked investors, they are very real, and they're probably going to put a ceiling on the stock in the near term.
It really is a classic tug of war. The bull case is simple and powerful. You've got this fantastic shift to high-value solutions, they're riding the huge biologics wave, and they're building out the capacity to keep it going. The bear case is just as straightforward. Management's own cautious tone, those very real tariff and currency risks, and that lingering weakness in the engineering segment. For right now, we see those two forces pretty much balancing each other out.
But this kind of disconnect where the short-term market reaction seems to ignore the long-term fundamentals, that's where things can get interesting. We think it creates a pretty compelling contrarian opportunity.
Here's the idea, a calendar spread. So you'd go long by buying a call option that's further out, say expiring in January or March of 2026. That gives you time to capture the upside when the market eventually looks past all this current noise. Then, to help pay for that long call, you'd go short by selling an out-of-the-money put with a closer expiration, maybe December 2025. That lets you collect some premium and is basically a bet that the sell-off was overdone. The whole idea is simple. You're betting that long-term fundamental execution will eventually win out over these temporary headwinds.
And that really leaves us with one final question to chew on. You have a company, Stevanato, that was totally transparent about the new headwinds and their plan to deal with them. So is the market just punishing them for being upfront while completely missing the much bigger story here? The story of a company that's successfully pulling off a multi-year pivot into one of the best neighborhoods in the entire healthcare sector?
And remember, this is not financial advice.